Hi everyone, welcome to today's episode of Quest Talks. My name's Haley Gant and I'm here with our other IRA specialist, Keaton. Today we've got a great show for you planned. We're going to be talking about how to set yourself up for retirement success in the 2019 year. So we've got a great show planned, going to be talking about how to plant all the great seeds for your retirement to start planning today for a nice, wealthy life later on. So we'll be right back, stay tuned, got a great show coming up. All right, everyone, so welcome to today's show. Once again, my name's Haley Gant. I'm an IRA specialist at Quest Trust Company. Today, I'm here with Keaton Munster, one of our other IRA specialists. Keaton's actually based out of our Austin office, so if you guys are watching from Austin, be sure to like, comment, and share. We're super happy to have Keaton on the show today. Today, we're going to be talking about all the different ways that you can make plans now to set yourself up for retirement success in 2019. So why is this important? Most Americans are not saving enough for retirement. 75% of Americans are not currently confident with their current retirement savings plan. Right. So we're here today to help educate you on how you guys can do that. So Keaton, why is this important? I
mean, it's super important simply because a lot of people don't think about it nowadays. You know, it's a materialistic world. Everybody thinks, you know, they want to, you know, make sure that they've got the best of the best, and they, you know, they're spending the money they're making. They're not thinking about what they're going to need in the future, and just making sure that they're keeping up with their friends, so everybody's, you know, not out of the loop. But I like to think that there's 5 main points really in thinking about your saving. So the first one would be to look into the accounts that you might have with your employer. Everybody's got you know, a job that offers, where you should be offering at least some sort of savings plan. If not, you still can open an individual account, whether it's a Roth IRA, a traditional IRA, some sort of brokerage account, or anything to put money away for your savings for your future. Because, you know, to be quietly frank, I mean, there's a lot of money that's out there that needs to be saved, because otherwise you're going to be stuck in a rut when you get older. So
yeah, and people are living longer. The cost of living is, of course, always going up. It's really important to make the plans today to help yourself save in retirement. I know on the last Quest Talk show, I was here with Sarah and Ashton, and we were talking about investing into real estate as a young adult. Right. So we kind of talked about, you know, breaking into the industry, the different things that you can do. But today we really want to talk about how you can actually save the money, because you can invest now, that pays you today, but your retirement is a long-term plan. You know, if you get older, when we're 50, 60, 70, and we haven't made the plans today, you know, we're not going to be able to work. We're not going to be able to, you know, do the things that we need to do in order to, you know, be able to live, basically.
Right. I mean, and just to touch on that, I mean, the average income in America for, you know, middle-class citizens, it's about, you know, 55,000, and with that, you know, the average retirement savings, if you just have, you know, the bare minimum, or you're just hoping that your employer's, you know, contributing to your plan, you retire at, you know, let's say 59 and a half, 60, the retirement age, maybe even at 65, you're looking at, you know, about 63 to 65,000 saved for your retirement. And I don't know about anybody listening and watching, but that's, you know, nowadays almost like a regular salary for an average American. There's no way that you can live on that for the rest of your life after retiring and trying to have a good time. So to move on to like one of the other main points that I'd like to point out for retirement is just that, again, your employer is going to offer a savings plan, whether it's a 401k, a 457, a 403b, TSP, some sort of pension plan, or profit sharing matching plan. Take advantage of that. I mean, your employer is giving you free money, literally giving you free money if they give you the option of a matching contribution. So
yeah, and let's even go beyond that. There's so many different buckets of money that I like to call them at Quest buckets of money that you can set up now that have different tax advantages that benefit you in retirement. So if you have a job with an employer, more than likely that employer does offer a 401k. Right. There's a lot of employers out there that will match that 401k. Take advantage of that free money. The different tax advantage accounts that you can have a 401k through your employer. On top of that, you can have a traditional or Roth IRA. Right. Guys, if you do not have a Roth IRA, you need to open up a Roth IRA. I think we say this probably on every show, young, old, doesn't matter. Roth IRAs are awesome. You don't get any tax incentive up front for putting the money into a Roth IRA, and it is pretty small what you can personally contribute into that account. But once you make that contribution into the Roth IRA, any profits from those investments grow completely tax-free for the rest of not only your life, but also your heir's life. Right. When you're thinking about your retirement, this money isn't just for you. You know, take advantage of all of the tax savings you can get by doing investments within an IRA. But as you grow up that account and you are older and there is money left over, and eventually you do pass that account on to your heirs, they inherit a completely tax-free account. Yes, we talk about retirements and wealth building and all of that stuff, but it's really bigger than just your own retirement. It is your overall wealth building and legacy that you're going to leave on for your family.
Right.
So Roth IRAs are huge. You know, if you have a 401k from your previous employer, don't just leave it there. Don't just let it sit. I talk to so many people all the time, I'm sure you do too, that they come in, they're interested, they find out that they can self-direct their IRA, and you see like a light bulb go off and they think it's awesome.
Every time.
And then they're like, you know what? I have a 401k sitting with my employer that I worked at 10 years ago. A lot of times people have like $15, $20, $30, $50,000 just sitting there not doing anything.
It sits like a rock for so long, and they just forget about it because they've started a new job, and they're worrying about that. And I mean, a lot of times it'll get rolled over into a rollover IRA, and it stays with that custodian, or they don't
even look at it.
Exactly.
They don't look at their statements. I was actually sitting with a client the other day. He's moving over some IRAs, has some 401ks that he's moving over. His IRAs, his custodian was charging him a 1% custodial fee, which comes out to $8,000 a year, just for his fees for an account that's been sitting there not doing anything.
Imagine what you could do with $8,000 in an account that you're actually doing something with.
Right, yeah. I mean, at Quest, our max fees that we charge a year are $2,400 for self-directing. Right. I mean, that's ridiculous whenever, you're not even doing anything with those funds.
Yeah, that's a little in between 3 and 4 years worth of fees for administration of an account for, a different custodian, or, maybe even more than that. It just depends on what you're looking at and what you can actually do with that extra $8,000 in this person's case. I mean,
yeah, we kind of went off on a tangent there. Let's go back to the different buckets of money. Guys, this is really important. So take advantage of it through your 401k, through your employer. There's a lot of free money there. Also the Roth IRA, kind of already touched on that a little bit, but let's talk a little bit about the health savings account. Okay. There's a lot of people out there that have a high deductible health plan through their employer, which means they also have more than likely a health savings account through their employer.
Right.
Guys, that's free money. A lot of employers put money in there because it's cheaper to insure your employees on a high deductible health plan. Right. So a lot of employers, that difference in that cost, they will actually put into a health savings account for you. What a lot of people don't know is you can also self-direct a health savings account.
100%.
Health savings account, you can take the money out before you're retired. You don't have to wait until you're 59 and a half. Nope. As long as you have an HSA in place at the time that any one of your medical expenses occurs, if you pay for it out of pocket, you can come back and reimburse yourself completely tax-free from your health savings account at any time. So
yeah, I mean, I could use myself as an example for that. Last year, at the beginning of the year, I had an appendectomy. Happens to half of America. Ooh, everybody gets their appendix removed, but it's not only is it terribly painful and it's something that has to happen immediately, but within a 24-hour period, I think I racked up anywhere between $65,000 and $68,000 in medical expenses. But I had to pay all that out of pocket over time, because obviously my HSA isn't that big. I'm a young person, but I know for a fact that the entire time that I had that HSA open, which was open before that even happened, for the rest of my lifetime, as long as I'm continuing to use my HSA, contribute to it, and grow that account through investments and everything else that I'm doing, I can always take that money out, the full amount that I've spent out of pocket to pay for those medical expenses, and reimburse myself, because it was, I mean, it's a qualified health expense.
Yeah,
and
you could go on a cruise.
Exactly.
Doesn't matter.
It doesn't. Yeah, it does not matter, because it is a qualified health expense. It's tax-free and penalty-free, because I'm reimbursing myself for something that the IRS has put in place for this rule, for this type of plan. And I can go on a cruise with my wife after the kids are gone, or go live on an island if I decide to, because I took advantage of a simple rule that was put in place for an amazing account that not only you can open yourself, but your employer is offering. So make sure you check on things like that. Just like Haley said, it's a bucket of money that just sits there that a lot of people just forget about.
Yeah, and there's so many different tax advantages. Your 401k more than likely is going to grow tax deferred. You're not going to pay any taxes as that account is growing, or when you roll it over to an IRA. It doesn't necessarily have to go into a Roth IRA where you pay the taxes going in there. You can move it over, let it grow, not pay any taxes on it until you get retired, or until you retire. And then the Roth IRA, totally tax-free distributions, as long as you wait until you're 59 and a half. That's two different buckets of money right there. The HSA, any of your health expenses or reimbursements for health expenses. The fourth one we like to talk about is education.
Yep.
So unfortunately for us, we're already older. We don't qualify for this because neither of us have kids and we're already over the age of 18. But guys, if you have children or nieces or nephews or any of those other annoying little kids running around, they are going to have, I'm a dog person, I don't have kids, I don't know. But you know, they're going to have educational expenses. A lot of people are sending their kids to private school now. If you don't live in an area with a good school district, a lot of people are sending their kids to private school, which is not cheap. No. You can open up a Coverdell education savings account. It's small. You can put in $2,000 per child per year until they reach age 18, but you can invest it, self-direct it, grow it. You don't even have to self-direct it. You could have it invested into traditional investments if you wanted to.
Exactly.
But it's still free money that compounds on itself that you can grow and use for any educational expenses for your children, kindergarten up until age 30. If you take a $2,000 Coverdell and you maybe do like a subject 2 or something like that in that account, you know, something creative with that smaller amount that starts in there, you grow that account to $10,000 in a year, you can immediately take that $10,000 out completely tax-free to pay for your kids' laptops if they use it for homework.
Which is what they do nowadays, everything online.
Home internet, a lot of different things. Now, you can't really use it for like extracurricular, like football uniforms, dance costumes, things like that. But, you know, college is not cheap. No. I know it's a big problem with, you know, student debt. We talked about it on the last show. But take advantage of the different buckets of money and just think about it as a long-term plan. A lot of people aren't saving enough today to really set themselves up for success in the future, and that's one of the things we really, really want to stress on in this show. Keaton, I know you've got some kind of stats and information about, you know, how you can save now to really set yourself up for success later.
Yeah, before I get into some of the specific numbers, one of the main things is to understand finances, understand how you can educate yourself and surround yourself with people that are knowledgeable, whether it's your financial advisor, you know, a friend that might be in the industry, you know, you call into a new custodian, understand, you know, a way to save money, or you just educate yourself. There's tons of self-help books out there. There's tons of podcasts. There's tons of free education everywhere. Make sure you understand the best way to save the money for yourself for the future, whether it's through retirement savings, it's through, you know, investing in stocks and mutual funds, but pick something that follows through with your moral investment strategy and the way that you live your life, because then you'll enjoy saving money, you'll enjoy investing that money for your future, because it's something that you're actually going to want to pay attention to.
In 10 years from now, 20 years from now, you will be very, very happy that you did. It's not going to save on its own. Your retirement isn't just going to pop up and get mailed to you one day. You know, you've got to take action now in order to really set yourself up for success in the future.
Right. I mean, because I mean, for our age group, according to the SEC, I mean, we should be saving, but for retirement age at 59 and a half, 60 area, you know, we have to have $1 million, $1.5 million saved to be able to live comfortably.
Yeah.
I mean, and if
I'm going to need a lot more to live how I want to live
exactly.
comfortably. Yeah.
I mean, and on top of that, I mean, the cost of living goes up the older we get. You know, everything starts to cost more. The vacations are going to be more. You got to pay these people more money to go have a good time. And if you're wanting to enjoy retirement and not have to have a part-time job, understand how much you need to be putting away in all the different avenues, especially the buckets of money Haley was mentioning. But to put that into perspective, there's $28 trillion in America's retirement accounts all across the board, regardless of whatever type of account it is. 8 million of that is in IRAs. Only 2% of that is self-directed. And this is all just from SEC numbers, but 2% of it's self-directed, regardless of whether it's self-directed into non-traditional assets. That just means that, according to that statistic, 98% of America knows what they're doing with their retirement money, and we all know that that's not the truth.
No, yeah, not at all.
And with that being said, think about what happened last year in the market. I mean, over a 12 to 13 month period, there was 13% in losses in the stock market.
Yeah, and that's really important to touch on too, because, you know, yes, very important to educate yourself, like set up a consultation with us, talk to your financial advisor, then probably talk to us again. Right. But once you know about the different buckets of money and the different advantages that they have, know what works for you to grow that account. You know, it's so small what you can put into a traditional and Roth IRA every year. This year they increased it by $500.
Which is the first time they've done that in what, 5, 6 years?
6 years.
Like that? Yeah.
I thought it was really funny. They increased the contribution limits by $500 to account for the last 6 years of inflation. Okay, cool. Now we have enough to retire on. Yeah, thank God for that extra $500 that we can put in there. But putting in $5,000 or $6,000 a year is not going to be enough to retire. a lot of people's accounts, once you mix in custodial fees, they're invested into CDs, what Nate, our vice president, likes to call certificates of depression.
It's the truth.
That a lot of times, I mean, once you counter in all of that, it's not even keeping up with inflation. I've seen statements where, you know, people have a large IRA, 401k, after this, all the line items, your account grew by $16.48 throughout the year.
Right, I mean,
that's like a meal at Chick-fil-A.
Exactly,
like, yeah.
I mean, and even whenever you think about all that money that's invested in the public market, stocks, mutual funds, CDs, things like that, and you know, you're gaining interest on stagnant money that's kind of just sitting in it, not doing anything because it's at least invested by your financial advisor or the custodian.
Yeah.
But take into account the amount of money that was lost last year across the board in the stock markets.
On like Christmas Day alone.
Exactly.
Yeah.
That was over a 12 to 13 month period, and then it really doesn't happen overnight. I mean, yeah, the market's starting to go up, things are starting to look better, but that doesn't happen overnight. You're not going to get all that money back immediately. All that money that you might have lost, that you could have been invested into something else you just kind of wanted to wait on, it's going to take a good 20 to 22 months for all of that to get back on track to start gaining the money that you made over the last 2 years in such great returns.
Yeah.
So understand what diversifying your portfolio means, right?
Yeah,
that's what we always talk to our clients about. You know, yes, it's always good to have money in the public market because you're always busy, you're gaining interest, it's starting to build up. But also understand that
you can let someone else manage it for you.
Exactly. But I mean, if you know how to make money
bad.
in other ways, you know how to invest your money in specific types of avenues, which is what we specialize in and help our clients understand. Talk to someone about it. Figure out how you can make your money work in the way that you want it to work because you already know how to make that type of money.
Yeah, and that's so true. At the end of the day, understand where your money is invested. Understand what you're investing in. Be knowledgeable about it. It's your retirement. I mean, there's a lot of financial advisors out there that are licensed to do this, but do they really have your best interest? A lot of them, I'm sure, might, but a lot of them want to make their fee. I've talked to financial advisors that don't even know that you can self-direct an IRA.
Yeah.
Like, had an argument with someone that works at Fidelity, and they're like, you can't buy real estate in an IRA. And I'm like, we have 17,000 clients. You definitely can. Understand your investment options and what is going to work for you, and know that whether you're invested in the stock market, whether you have a financial advisor, or you're invested in real estate, or using your IRA to be a private lender, know how that investment works, know how to protect your investment, how it can grow. And also, too, kind of going back to the stock market a little bit, it is good because real estate and self-directing IRA is not for everyone. I know I really stressed that last week. It's great if you understand how to do it and you're willing to put in the time and effort to make sure that you've done your due diligence on your custodian, who you're working with, and your IRA investments. But the stock market, over time, it does go up. It has its ups and downs, but what if you need to retire when we're in a downswing? What if, when this kind of happened over the past year, you're retiring, you're quitting your job, you need that money to live off of, and now your 401k is $30,000 less than it was a year ago because you ultimately have no control over where that money is invested.
Exactly. I mean, I'm sure you have the same thing, but over the last, pretty much the fourth quarter last year and the beginning of January, I can't tell you how many people I talked to that were moving money from their publicly traded accounts because they were just scared they were going to lose everything. And it wasn't even necessarily that they had investments in mind. They're just looking to put it in a place where they know they can make more money.
Where they know it's not going to lose anything,
and
on its own.
That's kind of leads us into talking about making the safe choice. The safe choice in doing your due diligence in a custodian. We specialize in a specific thing. Other custodians specialize in other things, but think about it this way. SAFE is going to be your specialization. When you're looking for a custodian, you want to follow four main points. Specialization. What do they specialize in? What do they know the best about? What do they focus on when it comes to investment education? For us at Quest, the principals of our company have been in the real estate investment game for 25, 30 plus years. That's what they focus on. That's what they have educated us as IRA specialists.
That's what we know and understand and what we're good at.
And that's how we understand to provide education to teach people how to use their retirement dollars to make money in real estate and other non-traditional investments. For the A part of the word safe, it's your account fees. Don't go into something without looking it up. I mean, for most custodians, their fee schedule is right there on their website. If not, give them a call and ask them about it.
Yeah, and we kind of say this before, don't just go with the custodian that has the lowest fees. You definitely get what you pay for. I mean, I'm sure my client that was paying $8,000 in custodial fees, obviously he wasn't very happy with that because his account really wasn't earning anything, but you know, understand you kind of get what you pay for, you know, and you want to do the due diligence. Ask them, what do they specialize in? Especially if you are looking to self-direct, you know, it's a whole new ball game for a lot of people that have never self-directed an IRA before. If we are not educated in what types of investments we hold, the process, things like that, our clients are never going to be educated either.
Yeah. I mean, how could we provide
you with the right education? No matter where you go.
Yeah, exactly. And I mean, the biggest thing is just to understand what the financial responsibility is of a custodian or a financial advisor administering and handling your account and your retirement dollars. So you also want to make sure it matches. You know, they have to match your moral standard and your moral ground, just to make sure that the path that you're going on in your investments is something that you can do continuously with this custodian or this person. Otherwise, you're just going to be butting heads the whole time, and then you're going to be picking at stuff. But that'll move over to, you know, when you're ready to fund your investments, you found that person, right? You know what they specialize in, you know what the custodian does, and then they're going to work. It's going to mesh correctly, right? You understand the fee schedule, you understand the fees that are going to be charged and how it's going to work, and it fits your financial pocket, your financial book, your financial, you know, set, however you want to look at it, the whole way. And finally, on the F of SAFE, it's going to be your funding times, right?
Funding times, yeah.
Right, yeah.
Fast.
So fast.
Funding times, yeah.
You want the fastest, don't you?
Yeah, you do. I can answer that for you guys.
Yeah,
you do,
exactly.
definitely.
Yeah,
you don't want slow. You don't want to lose a deal.
Exactly. I mean, even outside of real estate, but I mean, we focus on real estate, so obviously there's a deadline, there's a time frame.
Yeah.
But I mean, understand the funding times of the custodian. Don't go into it thinking, oh well, I know when I have to have it funded. I know when I need this, and I want to buy now. Understand that there is a review period of documents. For us, it's 24 to 48 hours. We'll get responded to you within that time frame, making sure that the transaction specialists are going on with it to tell you, hey, these docs look good, or we need to fix this. I'm going to reach out to the so-and-so for you. And understand that just because there's a specific time frame of review, there might be something that needs to be fixed. The correspondence is really big, whether it's for the client or for us, right?
Yeah.
I mean, we run into that kind of stuff all the time.
Especially as someone is doing their first deal or two. I mean, we work at Quest with so many people that are not only new to self-directing, but also new to real estate. That's why we love doing like this stuff with like Propelio, all the events that we host and attend and sponsor, like February 12th next week, Propelio's big event that they have.
Oh, yeah.
But, you know, the education overall of like how it all works is so vital whenever you're using your IRA for any of these types of investments.
Right, and we have tons of education at Quest alone. I mean, we have,
and that's the E in SAFE, education.
Yeah, the E in SAFE, the final letter, education. I mean, we have tons of education online. We teach classes in all of our offices. They're all free for anybody, whether you're a client or not. But that's not the point. The point is to even go back to what we were talking about earlier, educating yourself financially, understanding how the finance world works, and gaining knowledge that's going to better your future and your family's future and the heirs and the people you're going to leave behind, right?
And have a plan. Like as we kind of said earlier, retirement accounts are not just for you to avoid some taxes and save for retirement. It is a long-term wealth planning strategy. If you guys are serious as like entrepreneurs, investors, you know how it works and the different ways to take advantage of it and funnel some of your money and investments in there so you can pass some of these assets on to your heirs completely tax-free. I know my parents in their Roth IRAs, you know, they have several just different types of investments, but they have specifically chosen some investments that are in there to be in the Roth IRA. That way, that's a really big part of my inheritance is when I inherit it one day, that's a totally tax-free like chunk of land that has all appreciated completely tax-free.
Exactly.
And you know, at that point, I could even just take it as a distribution, not pay any taxes on it, or I could just leave it in the Roth IRA. And you know, I will eventually have to take it out because whenever you inherit an IRA, you do have to take out just a little bit each year. But it's a long-term wealth planning strategy, guys. You know, we're not here to plan your estate. We're not here to do any of that, but we're here to kind of put the idea in your head of, hey, plant these seeds now in order to really, you know, have a successful, comfortable, and wealthy retirement later. Thank you guys for tuning in. Everyone, be sure to like, comment, share. If you have questions, definitely let us know. Matt has a question. Thanks for tuning in today, Matt. Matt wants to know, if we lost a lot of money, should we leave it on trying to get our money back? The yield curve inverted, so based on history, stock will crash in the next 12 to 16 months.
That's a really good question. I mean, and you know, if you've lost money, like we were saying a little bit before, it's what Haley was saying. You know, it's going to fluctuate. The market's going up and down. It always has. It always will. And there's not going to be anything stopping that unless something comes up to fix that problem.
Yeah, and just consider your options.
Right.
You know, you have some options. Leave it in the stock market. Bank on it going up or down. Maybe invest into some like index funds that, you know, may not go down as much, or invest into some risky stocks where they have the potential to get that money back for you, or educate yourself about the alternative asset options that you have within your IRA. You know, the stock market may or may not crash again in 12 to 16 months. I've seen a few of the big like economists like speak recently, like Mark Dotzauer. I saw a multifamily economist from Freddie Mac speak the other night at an event here in Dallas.
Right.
Educate yourself about what's actually going on in the economy. If you've seen it on the news, it may or may not be like dramatized, like real, you know. It's, that's a golden nugget right there for sure.
And the biggest thing is the diversification. It's like Haley keeps saying. I mean, the market's going to be a specific way. I mean, it was a bear market. It was great. Everybody's making good money. But at the same time, that happens in real estate. Everybody knows what happened in 2008, 2009. Just because you're making money in a specific way in your retirement accounts and you're doing well and yielding a higher return does not mean that it's going to continue to go that way. Diversification is key. You know, split it up. Do not have all your money in one bucket. And even though there's multiple different buckets we talked about, that doesn't mean it's multiple different buckets in the public market or multiple different buckets in the private market. Those two buckets are their own, and they have their own smaller little buckets, right?
Yeah, exactly.
Make sure that you have it split up, because again, if the market crashes, at least you don't lose everything, because you have more money in the maybe real estate or, you know, some non-traditional style investments.
Yeah.
Or you have, you know, a lot of your money in real estate non-traditional investments, and then the housing market crashes again. Then what happens?
And due diligence. That's where it all comes down into it. You know, do be aware that, you know, as I'm sure a lot of people in real estate know, or that do watch the news, you know, they think, oh, the market's about to crash. We're on the verge. It's our largest expansion in like 20 to 30 years, you know.
Right.
Yes, but listen to the economist. I love watching Mark Dotzauer speak because he talks about how much he hates watching the news. He's one of the top real estate economists in the country. If you guys do not follow him, I would definitely highly recommend it. So just kind of know, I know I saw him speak at an event a couple of months ago, and he kind of referred it to, you know, if like we're in an airplane right now, we're preparing for a descent. We're not landing yet, we're not descending really fast, but we're, you know, put your tray tables up, we're preparing for a descent. So kind of just keep that in mind when you're doing investments. Educate yourself about the different options out there and how you can protect those different types of investments. Don't try to do it on your own. Align yourself with the right people. There's so many people in this industry, whether you talk to an IRA specialist or you go to an event and you talk to other investors that are doing what you want to do. There's so many options that you have with your IRA that you can self-direct it, not have it in the stock market, but you also don't have to be an active real estate investor just because you're self-directing your IRA. About half of the transactions that we fund at Quest are just people using their IRAs to be private lenders to other individuals, other investors that are doing deals.
They become the bank. I mean, they have their 9-to-5 jobs. They have other responsibilities outside of their jobs, you know, like families, children, other extracurricular activities or anything like that. But that doesn't mean that their free time and their free space, all they want to do is focus on their investments and their real estate holdings or whatever it may be. You know, having the opportunity to make passive income secured by a tangible asset is an unreal thought. People don't think that they're allowed to do that. You know, that's what the bank does. You know, that's what lenders do, right? No, that's not just for them.
No, that's what you do with your IRA.
I mean, like Haley said, about half of the transactions we fund, about half of the assets that we manage for our clients are promissory notes. People are literally using their IRAs and making them, in a sense, a bank, if you will, and finding investors that need money, lending it to them at whatever the agreed upon rate is, because the best part about that is in a self-directed account, you are drafting up the documents with your attorney, you and the borrower sit down and agree on the terms, and then you all draft everything out and sign it, and then you fund it. You have literally put it all in your hands, and you make it to where you know what your return is. And then again, it's a tangible asset. You can drive by, touch, see, and feel it. That's securing your funds. We're
going to take a quick break really quick. We're going to get a little bit more into that when we come back, so don't go away. Stay tuned. Be sure to share, comment any questions that you guys have. We'd love to hear from you, and we will be right back. right, guys, we are back. So before the break, we were kind of touching on using your IRA to be a private lender. Again, today's show is all about taking the actions and right education today to set yourself up for success in retirement. The reality of it is, though, not all of our clients, not even a lot of them, are full-time real estate investors. This idea to use your IRA to be a private lender and earn higher returns safe and secured by real estate is huge. We do so much education on it. It's really big in the real estate community because, you know, as an investor, if you talk to people with IRAs, you can open up unlimited doors to private financing sources. But that's not to say that every investment is a good investment.
Right.
You have this great option, but it is truly self-directed. Doing the due diligence on these investments and knowing how to protect your IRA investments so you build your SDEG, not zero value it, is huge. So
that is just as important. Doing your due diligence on your own investments is just as important as doing your due diligence on a custodian. Even though you found the right custodian, you've done the first step and you're like, this will work. I know that I can do this with this person in this company. Now, I'm ready to move some money around and have some fun and make some money. Don't just jump into it. Don't jump the gun. I mean, there's other steps. I mean, everybody gets super excited and then you get, you know, this premature excitement that just turns into what could build up a headache. It could explode in your face because you didn't check all the boxes and dot all the I's and cross all the T's. I mean, you need to make sure that you know, you're increasing your earnings potential at the same time as increasing your knowledge of investments and finance.
Yeah, and the reality of it is, it's really sad sometimes. We do have to zero value assets at Quest sometimes. It happens. Whenever you use your IRA to be a private lender, you can either loan that money out secured or unsecured. Secured, that promissory note that you guys draft up is going to be linked to the property. It's going to have a deed of trust. If your borrower does not pay you, you as the lender or your IRA as the lender can foreclose and take that property as collateral.
Right.
But to fund a loan at Quest, the minimum that we need is just a promissory note. We see things all over the board, from promissory notes drafted up by an attorney, like multiple pages long, deed of trust.
Right.
Everything is in there to protect that lender. Or we get a one-page promissory note that someone found online, drafted up in Word, and it's just the bare basic minimum. There is no security if you just loan your money out unsecured.
Right.
If your borrower does not pay you, if they run off and don't pay the money back, you essentially have no collateral. It's really sad and unfortunate, but we do have to deal with it at Quest. I mean, we do have to zero value assets sometimes, and you know, we don't like to do it, but we're not here to evaluate your investment. We're not licensed advisors. We do so much education to try to help you prepare yourself for these situations. But I mean, the reality of it is, it all comes down to your due diligence to protect your retirement investments.
I mean, yeah, it is very sad to see that a lot of times. I mean, especially because, I mean, I just personally am remembering, you know, a few stories offhand. It comes down to, you know, talking to the client and we have to zero value it and distribute the asset because either they didn't do their due diligence and look into the actual company they might have invested in, or the house they purchased, or the person they're lending money to, and then, you know, 6-7 months, you know, up to, you know, even, you know, a year and a half, 2 years down the road, they're like, well, what's going on? I haven't made any money on this investment. And you really look into it, and come to find out is
like they haven't received a payment in 4 years.
Exactly,
like,
and you're not, and they end up not being alone. There's multiple other people that deal with that. It's because they did the same thing, right? They didn't talk to the right people. They didn't do enough due diligence. They didn't reach out and say, you know, hey, how does this company work for you? And you know, maybe I need to look into this a little bit more with my attorney or my CPA.
And not to scare you guys away at all. I mean, we just want you to be aware of these things.
Learn from other people's mistakes.
Yeah, and if you align yourself with the right people, take the steps to do the proper education, have a good power team. Setting yourself up for success is all about having the different people on your power team. We touched on it last week. You know, we're going to touch on it again because it's important. It's one of the biggest ways of how you can protect your investment. Have someone that you can turn to. Have an attorney. Close at a title company. You know, take the proper steps to secure that investment. If you've never done it before, work with someone, make some friends in the industry, go to some events that have done it once or twice. You know, if you're a good person, you're willing to work hard, there's going to be people in this industry that'll help you out to do it as well.
I mean, and to use you know, our founder and CEO Quincy Long's words, this is one of the best things that we say to people all the time. Your net worth is your net worth. I'll say it one more time so everybody can, you know, get it. Your net worth is your net worth.
Yeah.
Investing, regardless of the type of investing you're doing, and especially for your savings, you can do a lot of it by yourself, but if you're not out there networking and you're not out there meeting people that have the same values as you, do the same types of investments that you do, that you're bouncing ideas off of each other, maybe you found a new strategy and you want to make sure it works. If you just jump into it and go for it, how do you know you're going to doing it the right way? Sometimes you might need a hand to hold, or a shoulder to lean on if you need to get those those little nuggets of information, right? I mean, and we're young. We just started getting into this a few years ago, and especially when it comes to investing. You had a little bit of a benefit because your parents were in it, but at the same time, in the company that we work in and the people that we deal with, you get to learn all this stuff on your own, and it helps you with your investments. But all the people we get to meet at these events, they're networking with each other, and I love walking up and just hearing people talk about new investments, especially when it's a new investor. And I know for a fact that the guy he's talking to has been doing this for a while. It's because he did what he's supposed to. Yes, that's scary, right? Walking up to new people, it's hard to go to a big event or a room of people that have been doing this for a while and it's your first time. But every person in there, you should shake their hand. You should try to remember their name, or at least get their information, because you'll probably end up seeing them again, and they could end up being a really good potential partner.
Exactly. And as real estate investors or potential real estate investors, no matter how many deals you've done, no matter how long you've been in this business, you are still always learning. There's always something to be learned, and as the years kind of progress and, we go through different cycles, the market's really hot right now, it's kind of leveling off, stay up to date with the information. As markets turn and cycles kind of go up and down, there's always an opportunity out there. Right. I know at Quest, one of the biggest hot topics of conversation for a while was wholesaling in an IRA. It's kind of got different, I personally probably would stay away from it. People have different opinions, but now you're seeing all these subject twos, a lot of other great investments. We see a lot of syndication investments at Quest, and we've seen some clients make a lot of money totally tax-free in their IRAs with those syndications. I was talking to one of our senior transaction specialists the other day, and just from his conversations with managing members of companies and gatekeepers that we deal with for our clients, it was crazy to hear that a lot of the managing members that he's talking to are receiving, not necessarily just from Quest, but they're financing their private lenders. They're all using retirement accounts, and they're using retirement in dollars. And he said that they're getting to the point where they're almost above the 90 percentile mark of receiving financing for these syndication deals through retirement dollars. I mean, I think that's awesome, because 2 or 3 years ago, people that were invested in these apartment complexes and multifamily deals were only the rich. The people that only had enough money, that extra 100, 150, 250,000, because these minimums are ridiculous to put into these deals to make money personally. It's not the case at all anymore.
Nowadays, that people understand they have the option to move money into a self-directed account like we administer at Quest Trust. They can turn around and put that money directly into that type of investment and get the same type of returns, but they're not getting a giant 1099 or having to file a 990T or anything like that at the end of the year, because they did it in their retirement account, right?
Yeah. So let's touch on that a little bit more, because you kind of talked about, the high net worth individuals, these minimums that you may have to invest into some sort of syndication or apartment deal. But what if someone doesn't have a lot of money in an IRA or a retirement account, or any at all? How do you start now to set yourself up for success if you don't have a retirement account? Obviously, step number one, you need to open one up. If you don't have any IRAs, if you're not self-employed, get yourself a Roth IRA. Right now, you can still max out your 2018 contributions for all of the accounts. Guys, if you have not opened up an IRA, what that means is you can max out your 2018 contributions. Say you're under the age of 50, $5,500 for 2018, $6,000, extra $500. $6,000 for this year. That is just over $11,000 that you as an individual can put into an IRA right now. But as we touched on, retirement is a long-term plan. It's not just you. You have a family that you also need to think about. You can put in $11,500. If I have a brother, he could put in $11,500. Sister, $11,500. If my parents don't have IRAs, they're definitely over the age of 50. Sorry, parents, hope you're not watching. They can put in just a little bit more. They get an extra $1,000 catch up for each year. Between 4 to 5 family members, that is over $50,000 that we were just able to put into an IRA that we can now all partner together and not combine the accounts, but use together on an investment. That is so powerful.
That's a strategy that you and your parents use. I mean,
that's exactly what I did. I just piggybacked right off of them. So my parents have been Quest clients since 2004. They've done hundreds of real estate deals. So, and you know, I help run our Dallas office with Quest. I've seen that office go from a 2-person office to a 10-person office in just a little over 2 years. I don't have time to go out there and find properties and buy them in my IRA and go out and door knock and target those pre-foreclosures that I could maybe, you know, take advantage of with my small account. So what I've done is I've partnered my Roth IRA with my mom's Roth IRA for now 3 different fix and flips. Within a year and 3 months from the first 2 fix and flips, my IRA almost doubled in size from $11,000 to almost $20,000. So many people get the blinders on. They're like, I only have $10,000. I don't have an IRA. I can't start. It's not enough to do anything with. And that is not the case. I love hearing that now.
I love hearing, I only have this much money. I only have, you know, a couple thousand in an old 401k for a previous job, and get excited about it. Just because it's only $2,000, $3,000, $4,000 does not mean that you can't invest your funds. In real estate, we see it a lot. I mean, you can't buy a house with $2,000, $3,000, $4,000. That doesn't mean that you can't invest in purchasing options, assignments,
notes,
yeah, exactly, subject tos, tax liens. I mean, we've got Kristen Gerst here. She was responding to Matt earlier, where he was asking about the market, and you know, when will, the next 12 to 16 months, right? She was saying the yield curve inverted for the first time back in December, and we've got until Labor Day, according to history. So get your financial house in order. That's perfect. I mean, I really like that, Kristen. And then, like you said, one of the main reasons you like buying mortgage notes, it's backed by real property, and returns. The returns are set. I mean, again,
Kristen buys and sells a lot of mortgage notes. If you guys want to know how to buy and sell real estate mortgage notes, Kristen Gerst, Capricorn Mortgage Investments. I mean, of course, at Quest, we can never endorse or recommend anyone, blah, 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 disclaimer. But Kristen has guest spoke at several of our events now. They're recorded live on our Facebook page. She's on Iron Heels every week. She kills it. She buys and sells a lot of notes, and she does it because they're secured by real estate. It's such a huge opportunity there. Just kind of find your niche. Know what interests you. I mean, I'm like a real, I like to see houses. I like to touch it, see it. Notes, the numbers on paper, not my cup of tea, just because I don't fully understand it right now.
It doesn't work with your path of how you like to invest your funds. You know how to make money doing it a specific way.
Partnering for fix and flips with people that happen to be my parents that have done it for like 1,400 times, it's, you know, there's really a lot of opportunities out there.
Another thing that we like to say at Quest is invest in what you know best. I mean, you might hear it all over the place, but we firmly believe in investing in what you know best is the best way to make the most money. And keep in mind that this is also not just money for you for the future. If you're doing something business-wise, if you're self-employed and you're running an LLC or a limited partnership or whatever it may be, or have a JV with a friend of yours, and y'all are doing pretty well in the business that you're doing, chances are you can do that in a retirement account. If you can take title to something, chances are you can do that in a retirement account. Keep those kind of things in mind, because you might be doing really well, but at the same time, every day that you make $1,
you got to pay some of that back.
You got to pay some of that back to Uncle Sam, right? So think about how you can work in your personal capital, your business capital with your retirement money, right? It doesn't have to necessarily mean that you use everything in your retirement account to save for the future. Oh, now I need money, but I should have done part of this with my own money, right? Well, if you take a distribution from your retirement account to give yourself some money, then you're gonna think, oh man, I should have done this back in my LLC. You can do both of them together, whether you're going to partner your own retirement money with your own personal money the correct way, which is why you would call Quest Trust to call and talk to us and understand how that works and the rules the IRS has in place for that. Or pick and choose how you want to do the investments. Maybe you do a few of them in your retirement account, you do a few of them with your own money or through your LLC, and you're still getting the same returns, but some of it is going into a bucket that's going to greatly advance your future of retirement savings.
Yeah, and to kind of touch on that, so there are some restrictions when you're doing that. You want to be very wary when you're using your own business and your IRA funds. You know, we do a lot of education over that. We'll kind of get to that in a second, but you know, you are very right. Like us as individuals, we are taxpayers. You can do all the investments in your own name now, and you think, oh, I can only put in this much into a retirement account a year. I might as well just do them in my own name. No, open up an IRA, put some money into it. Even if you don't want to self-direct it and it's invested into stocks or something, at least you are earning some sort of small interest rate that is totally tax-free. Again, free money, take advantage of it and let it compound on itself. It's huge, and you will be really happy that you did once you are retired. But yeah, so Susan has a comment. Thank you for tuning in, Susan. Susan is actually a new Quest client as of a few weeks ago. Thank you. We're very happy to have you. So she's really excited to be learning about how this works. So happy you're tuning in today. That's why we do this. I mean, we do the show every other week. We're not on here every week, but because we've got a lot of moving parts, a lot of us kind of travel in and out for these shows, but we love to educate people about IRAs. Even if you're not ready to like open up a self-directed IRA, you're not ready to buy real estate with your IRA, talk to us, watch our classes, watch these shows on Propelio, watch the other Propelio TV shows. There's so many resources that'll at least kind of help point you in the right direction and figure out if this is something that you want to do. To kind of switch gears a little bit, let's talk a little bit about what if someone has a 401k through their employer and they leave that job? What are your options? What if you have like, I talked to a lot of people, they were maybe only with that employer for like 2 to 3 years. So they leave that employer, they have a small 401k just sitting there. Don't just let it sit. We can't reiterate that enough. That always happens. But
understand your options, right?
Yeah. When you're ready to move those funds out of your 401k, those funds will roll over directly into a traditional IRA without any tax implications. If you open up that traditional IRA at Quest, you can self-direct it, buy private assets, things like that. But consider a Roth conversion. If you have several years until retirement and you've got maybe a small 401k that you've maybe left the job and are ready to roll over, if you have a 401k that is say like $15,000 or $20,000, it's probably about like, about like 20% of the 401ks that we see that roll over are under $50,000. Some of them are large, but a lot of them are small. And again, people get those blinders like, I can't do that much with that money, which you can. But also think about that money from your 401k in a traditional IRA is all going to grow tax deferred. If you have 10, 15, 20 years until retirement, if you take that $15,000 and you leave it in a traditional IRA and you invest it and you grow it, and say by the time you're retired, it has reached $1 million, which self-directing is definitely not unheard of. If you had left that money in a traditional IRA and you grow it to that substantial large amount, you have essentially just created a really large tax liability for yourself, where as you take your distributions from the traditional IRA, none of that money has been taxed while it's growing, but you have to pay taxes on that money as you take your distributions later at retirement. If you have a small account like that and you've got a lot of years until retirement, definitely consider converting some or all of that to a Roth IRA, even if you only do portions at a time each year, because any amount that you convert into the Roth IRA will be taxable to you as income for that year. It's added to your income and you pay ordinary income taxes on it.
So make sure you're consulting with your accountant and your CPA, because I mean, it's a great strategy. It really is, converting tax deferred money to a Roth account, a post-tax account like a Roth IRA. But understand the tax implications.
And avoid creating that large tax liability for yourself, because if it's that small amount, you've got a long time until retirement, pay the taxes up front, get it into a Roth IRA. Once you pay the taxes going into the Roth IRA, it grows completely tax-free for the rest of your life and your heirs' life. It's really amazing how many taxes you can avoid by doing these types of investments within a Roth IRA. On top of that, if you are maybe a little bit closer to retirement and you don't have a Roth IRA, you need to open one up and put some money into it. The reason being, every Roth IRA has a 5-year clock from the time that you open it until your distributions actually do become completely like tax and penalty free. The two qualifications to tax and penalty free distributions from a Roth IRA are you have to be 59 and a half and you have to have had the account open for 5 tax years. But any funds that you have taken from your own money and like made a contribution into the Roth IRA, you can actually take out at any time completely tax and penalty free. If you are a young person and you're maxing out these contributions to a Roth IRA, which you should be, if something happens, if you get appendicitis and Quest doesn't pay for your health insurance, you can take that money out of your Roth IRA that you've personally put in there and you're not penalized for it.
It's essentially like a savings account when it comes to your contributions.
The growth does have to stay in there until you're 59 and a half, but your contributions can come out at any time. And what a lot of people don't know, which I think is really cool, we actually both learned this during our IRA specialist reviews. At Quest, we were all a little unclear on it, so we actually called PenServe, the company that does all of our documents. Conversions, when you do a Roth conversion from your traditional IRA into your Roth IRA, that has its own 5-year clock. After 5 tax years, even if you're not 59 and a half, that principal amount that you've converted is treated as a contribution. You can take it out early, tax and penalty free.
Yep.
That is huge. That's probably the biggest nugget from this show. If you're 30 years old and you do a Roth conversion of $20,000, 5 years later, you can take that out, no tax, no penalties.
Right.
Now, growth from that has to stay in there, again, until you're retired. You can take it out early, but you're taxed and penalized. Again, leave it in there, set yourself up for success. But
and the cool thing with that,
it's huge. Yeah,
and the cool thing with those distributions from the Roth is they're in tiers. The first tier is what we just talked about. You know, there's the contributions. Those come out tax-free and penalty-free at any time at any age. That's the first bucket that touches that the money that's touched whenever you're distributing funds from a Roth. The second bucket is any Roth conversions that you've done from any tax-deferred accounts. Haley just went over the qualifications for you to take that money out tax-free and penalty-free. So once you reach those qualifications, second bucket of money tax-free and penalty-free. And then finally, the very bottom of the bucket, or the third bucket, if you will, is your earnings. Every dollar that you made on everything that you've invested. Those are very specific. Obviously, those have a little bit more of a restriction on them, but keep that in mind whenever you're distributing funds, whether it's for something that happens in life or you just need some money to go out and have fun, vacation, whatever you want. That's how it's distributed through a Roth IRA, as opposed to everything in your traditional or tax-deferred accounts. That's always going to be taxed when it comes out. It does not matter. It will not season and get to a tax-free point. It will always have to be taxed at your tax bracket. And also, one last thing on those Roth conversions, keep in mind that when you're doing those conversions, when you talk to your CPA or your accountant, if you're at teetering on, in between two different tax brackets, you'll want to make sure that you put that into play, because if you're going to be projected at a specific a specific amount that you're making this year before any adjustments, that conversion is also adding to those to your adjusted gross for that year. So you could bump up to the next bracket. So that's something you really want to keep in mind. Talk to your CPA, talk to an accountant.
Yeah, I mean, so many people come into us and they're like, oh, well, what tax bracket will I be in? I'm like, one, look it up online. You could probably find out the different tax brackets. Two, talk to a CPA. We're not here to advise you on that. But we're going to take one last break. Thank you guys, everyone, for tuning in today. We will be right back. We've talked a lot about how to plant these seeds to set yourself up for success. With the last 10 minutes after this break, we're going to talk about what you can do today to actually apply them. So we'll be right back. All right, everyone, we are back. We are almost done with today's show, but not yet. We've still got a few more nuggets of great information for you. So we've talked about Roth IRAs, we've talked about 401ks, moving it over, Roth conversions, getting your family involved. But one of the big things we haven't really touched on yet, and it's going to kind of segue into next week's show, is there's a lot of real estate investors out there that are entrepreneurs. You guys are self-employed. You don't have the luxury, I guess, of having an employer match fund in your 401k. The IRS knows this, and they have actually set up special accounts for people that are self-employed that allow for much higher contribution limits. Next week, we are going to actually have our CEO, Nathan Long, and one of our top IRA specialists, Rebecca Miller, right here on the show, not next week, but the week after, talking about employer plans. Rebecca is actually our solo 401k expert.
Rebecca knows everything there is to know about specialty accounts when it comes to self-employed individuals. Her knowledge is unreal. It's awesome. It
is. So she's been with Quest for about 8 years. When she started working at Quest, we had, I think, 20 employees.
Yes.
And today we're pushing, I don't even know how many we have. It's a little over 120.
Yeah, I mean, it's 100 alone in the corporate office in Houston, I believe.
Yeah.
But I mean, just to kind of give you all an idea, as self-employed individuals, that's a lot of real estate investors. Again, like Haley said, Nathan and Becca are going to be going deeper into this on the next episode that we're going to be tuning in on. But SEP IRAs and simple IRAs, you are the employer. You have your own business. If you have a SEP IRA or a simple IRA established, I mean, obviously do your due diligence on these accounts, because both of them are not for the same types of businesses. They're both kind of structured for different types. But in the SEP IRA, you can put up as much as $55,000 for the year, for 2018's tax year, as a contribution for the employer. And then for 2019, it goes up an extra $1,000 to $56,000. But still, that's a pretty large sum of money that you can put into a retirement account as an employer.
And And we always talk about, it's not necessarily about how much money can you shovel into a retirement account, how much money can I save and hoard and shovel in there. It's not about that. It's about knowing the different types of accounts that you qualify for, that you can make contributions to, and just putting a little bit in each one and knowing what needs those different types of accounts fit. If you're self-employed and you don't have that 401k match or the employer giving you free money, you can put up to $56,000 into one of these self-employment plans. The most common ones that we talk about are the SEP IRA and the solo 401k. That $56,000 contribution is also tax deductible. If you're self-employed and you're looking for ways to reduce your tax liability, make a big contribution to a SEP IRA. Granted, there are some, kind of requirements if you have different employees, how long they've worked for you. We can get into all that with you later, or just tune in next week. But also, guys, if you're self-employed, the solo 401k is awesome.
Amazing.
Rebecca is our solo 401k expert. I'm kind of next in line. I've been doing a lot of training about it. All of our IRA specialists have at least a good base knowledge of the solo 401k, but
we can help to make sure if you qualify for it or not. Right?
Yeah. But basically, if you are self-employed with no common law or W-2 employees, and you're able to legitimize that account and make a contribution, meaning you pay yourself some sort of income within the first year, you can make large contributions to it, give yourself tax deductions. You can make Roth conversions within the solo 401k. And the solo 401k gets special exemptions that all of the other accounts don't get.
Right.
Now, it comes with a lot more responsibility. You are basically your own trustee for that account. It's a different fee schedule.
All the reporting is on your your lap.
But guys, going to give you some homework over the next 2 weeks. If you're self-employed and you're interested in that, do some research on it. Go online to our website. We just re-recorded our solo 401k class. Nathan is actually the presenter on that class on our website. Right. But that account is awesome. It gets really cool advantages. It does come with more responsibility, but a lot of our clients, once they get it set up and they're going with it and they know how to use it,
they understand the complexity is amazing.
Yeah.
And the things that are quote unquote dangerous are actually really advantageous for self-employed individuals.
If you know how to use it.
Exactly.
Yeah.
If you understand the account, you know how to use it, and you have a team around you to help make sure that it's done correctly, there's nothing that you can't do with that type of account. I mean, and even for the people that don't necessarily qualify for the solo K, don't let the SEP IRA and the simple IRA slip away.
Yeah.
Again, like we've been saying the whole time, it's all about due diligence, regardless of what part of the investment strategy or the investment time frame you're in. To add more to that homework that Haley gave you, look up at the solo 401k, whether it's on our website or your own research. Look into the SEP IRA and look into the simple IRA and understand the 3 different plans and understand which one would work best for you as a self-employed individual. Also, keep in mind when you're doing that, if you do have eligible employees, these plans can benefit them too. If you want to figure out a way to help these people save some more money and set them up for a better future for their retirement, so they can enjoy retirement as well, even though they might be your employees and you might have quote unquote made it and you're doing well, give them the option. Give it back. I mean, these plans are specifically set up for self-employed people as employers, but also if they have employees.
For their employees, yeah. Yeah, because as an employer, if you have employees, you cannot just exclude your employees. You can't have a nice big old plan for yourself and then put your employees in a different company, LLC structure to avoid them. You can't do that. But you also, as hopefully like an ethical person, you would want to set your employees up for success as well.
Right.
People have families, people have living expenses. At Quest, we get the luxury of, we do this all day, every day. We are very well versed in retirement accounts, but the reality of it is most of America is not.
Nope.
I was reading some stats online. There's a huge gap, like I think it was like 35% of Americans have like over $100,000 saved in an IRA, and then another 35% have $0 to $10,000. There's a huge gap there. But everyone's gonna have to retire. No one is gonna be able to live and work until they die, basically. You're gonna,
and nobody wants to. I mean, you want to be able to enjoy your life. I mean,
some real estate investors do, but
and even when it gets to that point, even as a real estate investor, they enjoy it, and so much to the point where they can go to the Virgin Islands and enjoy a week away from the entire world, as long as they have Wi-Fi to make sure that their funds
check
are being
their emails,
exactly. But at the same time, they don't have to sit behind a computer. They don't have to sit at a desk because they found what they wanted and they found their niche. They're employed until they pass, but they're leaving a huge bucket of money, assets, knowledge, and strategies for their children, their heirs, their grandkids, people like that.
Yeah, and guys, it's really not hard. give us a call at Quest, set up a consultation, go read online. And it's actually kind of funny touching on that. And I do a lot of research preparing for these Propelio TV shows, just seeing what information I can find online. And it is a really big issue that Americans are not saving enough for retirement. If you go online to like Forbes.com or like MarketWatch or other websites like that, and you look up retirement, there are so many articles about Americans are not saving enough for retirement. People are living longer. How to set yourself up for success with retirement, which is kind of how I got this idea. But all of those articles out there, very rarely do they talk about self-directing IRAs.
Right.
They just talk about saving more now, putting more in now. As you're younger, that's part you put in now when you're younger compounds on itself so much more, you know, versus doing it when you're 20 to 30 years old versus 40 to 50.
Right.
That makes a huge difference. But you know that there are other options out there. It's not hard to get started. You know, first things first, open up an IRA, whether it's at Quest, Fidelity, wherever, it doesn't matter. Get one open and start making some plans to put money in there. And you know, kind of look at what are your long-term goals. How do you want to live when you're retired?
When do you
How
want
old
to
are
retire?
you now? Yeah. What are you going to have to do to get there? What do you need to be doing throughout now, this year, next year, 5 years from now, to get to where you want to be? Again, your retirement isn't just going to fall into place on its own. If you're expecting that to happen, you're not going to set yourself up for success.
Right.
Keep repeating that, but it's so true.
It's just the truth. I mean, it can be said 100 times, and some people just still don't get it. I mean, and really understanding it, the education is honestly the biggest thing. Due diligence is huge. Setting yourself up for success is huge, but education is
number one.
It has its own power, because the most educated person, if you're the most educated guy in the room, or at least you think so, I guarantee there's a guy that's, or even a guy or gal sitting right next to you that might be more educated, but it also could be in a whole different strategy. Education is huge. Haley and I, Nathan says it all the time, Quincy says it, Nate says it. I mean, they all say it whenever they're speaking at these seminars that we go to all the time to talk to people and educate them. They put us through some rigorous education and training to get us to understand how these retirement accounts work. I mean, because self-direct is just a marketing term. A self-directed IRA is not anything different than an IRA that you hold with any other custodian. We specifically use that term to help our clients and other investors understand that you are actually truly self-directing this account. You know, and if you're educated,
you make all the financial decisions for that account.
And if you get the education you need to make sure that you understand what you can do and can't do, then there's no limit, there's no sky, there's nothing that you can't do. And even if you run into something you think it's cool and you really want to get into it and you really want to use your retirement dollars, we've been put through the test, and we continue to learn more and more stuff. We're not at the a stopping point of education. We do this every day, all day, and talk about it more and more. And I can't tell you how many times I learned new things and different strategies about something I thought I was super knowledgeable on. So I mean, call Quest Trust, call your custodians, call your financial advisors. Make sure that you're asking the questions that you need to ask, because there is no stupid question when it comes to your finances. It doesn't matter how simple it is.
Make a plan. And even if you call us and then you're like, oh, your head is spinning, call us again. It doesn't matter. It's always free to talk to us. We're going to wrap up the show. Thank you guys, everyone, for tuning in. If we have any last minute questions, be sure to get them in now. Before we go, I do want to thank everyone for tuning in. Be sure both Quest and Propelio have some really awesome events coming up. Next Tuesday, Propelio is doing their big DFW REI meetup over in Arlington, Grapevine. I'm sure it'll be in the comments on this video somewhere. February 12th, that's going to be great. They've moved that event to quarterly, so don't miss it. It's a lot of fun. And Quest, we do events every week. We do free lunch and learns in Dallas every Wednesday at noon, free lunch and learns in Austin every Thursday at noon. If you guys are watching and you're in the Austin area and you have not been to our Austin office, do yourself a favor and go to one of our classes there. Look at you grinning. That office is so nice.
We have fun. Come check it out. It's our newest office at Quest Trust. We enjoy it, and we just started doing classes in that area. I mean, we service
we've got
the
a full
Central Texas area.
Full staff in both Dallas and Austin now. Transactions, auditing, marketing, IRA specialist, classrooms. It's really all there. But last but not least, guys, set yourself up for success. Education is key, but don't get analysis paralysis.
Yes.
We do have an awesome account opening special going on right now.
Yeah, we do.
Quest Love, share the love. I wore a pink shirt in honor of our Valentine's Day promotion.
Wear a little bit of purple to show some love.
Yeah, if you open up your IRA account in the month of February, your loved ones, your family members will get an account for free. Again, use multiple accounts together. You can partner them together. max out contributions to multiple IRAs between you and your different family members, then use them together. We'll teach you how to do that. But give us a call, 855-FUN-IRAs. We'll also be commenting below. I'm very active on Facebook. I know Keaton is too. Shoot me a friend request. All I do is post about Quest and events and Propelio videos on my Facebook page. So, you know, give us a call. We're always here to help answer questions and help just be a good resource to you guys.
Right. Absolutely.
Awesome. So that's it for the show. Thanks everyone for tuning in.
Yeah, thanks everybody.
We'll see you in 2 weeks when we'll be talking about employer plans and I think some solo 401k horror stories and case studies.
Oh, nice.
According to Rebecca, yeah.
Make sure you tune in for that. Thanks guys. Give us a call. We want to hear from you.
Thanks.
Hey everybody, I'm Ryan with Propelio. If you like what you saw, please subscribe. Turn on those notifications and stick around for more. We have tons of content like this all over our channel. So if you want to learn more about real estate investing, stick around, watch Propelio TV, and we'll see you later.